Morning, everybody. Well, I guess there are times where we have to call a spade, and markets are not going to be as forceful as the way we want them to be all the time. But it's very much in understanding that people who come to financial markets have to be able to experience these types of swings every now and then. And the best thing we can do is to be appropriately prepared for what is to happen and how we're going to try to turn moments of crisis into situations of opportunity. And in our ability to be able to look at what markets are attempting to be able to pull on, we'll look a little bit also about a few technical conditions, about a little bit on global events, and then we'll zone in into the Philippines again and see what the state of the market is and how we can come around to be able to look for some sort of opportunity in all of that. So as a summary of what I'm going to talk about today, we've seen markets dive quite heavily. Like they said, the new year wasn't exactly very happy, and we've had quite a bit of a nasty opening. I have not seen such an occurrence so far in my entire life in the stock market, where an opening ceremony was very, very bleak. But as prices have already fallen to quite a bit of conditions, we're going to have to see whether is the price right and is the timing in accordance with what we should be looking at already, or have prices fallen down too far too soon and that a possible counter rally is about to happen, of which that we can still try to be able to make some sort of opportunity come out of that in terms of the timing essence. And yes, we've come to some bearish-like phases because, as April pointed out, in the definition of a bear market, that a 20% zone has been breached. We'll talk about that also later. And we'll see also whether it will stay here for a long time or not. And right now, what we need to do is we need to make sure that the market's ability to sell off has already taken place. 1 or 2 days of rebound does not make the justification of a trend reversal, and therefore we have to be able to stare clearly at what are those particular types of patterns that we can try to take advantage of. Now, of course, navigating through a slowing bull or a little bit of a weak bear market requires a little bit of some strategy. I don't think that emotions will carry you anywhere useful as of this particular moment. So we have to be a bit more patient. We have to be a bit more discerning. We want to make sure that we exercise our conditions of prudence when we move into the market condition. And how do we appropriately position ourselves, particularly when we see a very drastically oversold market, to come in maybe slowly and take whatever opportunity we can out of that. I would agree with April. This might last a little bit longer than usual. I don't think it'll last us on the grave part of the sample that she showed. But let's also have a look at what we've seen also in the past to see if we can try to predict what we'll also be seeing in the very near future. So we'll start first with the global conditions. And like I said, the opening of the year wasn't really very nice. We've had quite a bit of markets, both on the Philippines, in developed markets, emerging markets, and of course even China. You see the line there in red showing the heaviest declines of everything. And so far for this year, the low point came out to between 17 to 15.8%. But as you can clearly see, the Philippines was also down quite a bit. We're down closer to about 9.9%. This was taken about 2 days ago, so we have not seen the last 2-day rally yet and have not put that back into the effect. But one thing I think that you can see that the ultimate cause here did not come from the Philippines, all right? And so it was not endemic into the Philippines. It was not something that we were doing wrong, but the rest of the global markets are going through a particular phase right now, in which that phase is what we're going to have to stare quite very strongly at. Moreover, as we are also looking to the conditions that it was a global condition that's keeping markets relatively depressed, we also have to look outside of the Philippines to see if any certain types of movements by certain governments and economic people in there to try to be able to instigate some sort of relief rally or stimulus plans. And you'll probably get a hang of this when you see some words from some Chinese officials, or the other day from Euro officials, telling you that just in case markets behave the way they did and continue downwards, they were very much ready to push the help button to try to get stimulus back into place and try to calm markets. So if you were to look at the state of events and look at that it might be very difficult for you to perhaps say, it's time for me to sell my position right now after the market has fallen down. Right now, governments may come inside to defend in case things get a little bit more hairy, and you might not want to do that as of this point. You probably want to wait for markets to show some lift before doing such things later on. Now, yes, as April also pointed out earlier, China's been in the focus for everyone. Of course, China is a very big market. Many of the economies around the world rely upon the usefulness of their economy and how they can try to be able to do that. They used to be known as the manufacturing hub of the world. Right now, they're trying to switch over to moving more to the consumer and services area, and that transition may take time. And those people who have been reliant upon such manufacturing conditions are now going to start pulling back. They're afraid that growth levels are starting to slow, and that's the reason why, of course, that the stock market wasn't really working too well. There's a lot of excess that have to be mopped up from their economy, and again, that does not happen overnight. It takes time to be able to unwind. In consequence of that, we had a lot of foreign investors in China pulling some money out, and because of that money coming out of China and being moved elsewhere, we've seen the effect on its currency. The yuan has actually devalued quite a bit. As you can see from the graph over here, it's been quite a bit of turmoil that we've seen since August, September last year and continuing on today. But we've been seeing some sort of weakness in upward momentum, and that would mean that it seems that there could be the capacity for things to pull that down a little bit. In fact, I'm already seeing some signs in other Asian currencies. I hope that translates to the same when it comes to the peso, which has also been quite weak in recent times. Now, another factor that also came in was, of course, the rise in interest rates in the United States. The first one of which had not done in a very long time, happened in mid-December. And as they attempted to be able to increase the push of interest rates, it affected to be able to jar everybody and say, all right, that's it. The period of low interest rate environments could be over, and perhaps there could be the possibility of interest rates going up already. I guess the question today is not whether it will go up or not, but a question of how fast. And of course, as you feel through economies right now, it seems, of course, with the stock markets also going down, the more likelihood is that this increase might also take time. So perhaps the fears of a rapid advance in interest rates perhaps are not in view, and it'll probably be a bit more protracted, so perhaps you don't have to worry about that too much. However, if we look at history and see what has happened whenever interest rates finally bottom off and start to rise. And the graph that you would see here is a picture of US interest rates. That is this blue line you see here. And behind it is the Dow Jones Industrial Average. And if you were to look at this first section, which I have drawn up here, that was the first time that you've seen rates pick up. And look what it did to the market. It forced it down very, very sharply first and allowed it to go sideways for a while, but it recovered right away after that. Second instance, again, interest rate pushed up, flat market for a while, market went up again. Third instance, and the only instance so far in the historical sample I have so far, this was back in 2000. We have this push up in interest rates. The market went sideways, but then something else caught on. This is the dot-com bubble in that era, and what happened was very unique in that situation, so it's very hard to say a replication of that will likely be the case. Then, we have another one over here. This came off 2005. Again, we also had a very flat market as interest rates attempted to be able to move back up. And so we kind of get the picture of they're seeing that maybe 3 out of the last 4 times, and that every time interest rates move up, people have to bite the bullet and say, all right, it's happening. Now, how do we come around, look at the things that I've been doing and try to factor that in? And while that factoring nature comes in, markets are usually a little bit weak, go sideways for a while, be a little bit more volatile, until they can see that the economy starts to bite off and produce much more than what people are speculating that it might not. And that's when, of course, things attempt to hone up again. Now, like I said, December 15, we had the first interest rate hike again. And US markets, as expected, started to be able to adjust downwards because of it. And we might have to go through these periods for maybe a few months to be able to try to sense up to how much lower that this thing can sense off with regards to how interest rates are. And I'm sure if we probably see interest rates climb up much more slowly than what they are thinking about, then perhaps that might give much more credence that there could be a recovery here, or maybe just involve a wider consolidation range for US markets. So given the conditions we do have there, the only thing I guess that's bothering me, so to speak, on the technical aspect is if you were to have looked at an uptrend line, which I started back in 2009 going upwards, that trend line in the Dow Jones has already broken. And usually that signifies a corrective event, possibly even a very short bearish type of event that can actually culminate. This is the S&P 500. It's a bigger US index to be able to account for. The very different thing about this is it has not broken its major uptrend line yet. It's still intact. We've had two tops here, and that's why we're still relatively defensive on this. And hopefully we can see some support pressure build where prices are rather today. So I think that you might be able to see some sort of rally action here for a while because this is a good place to start looking for some defense in terms of support. I have my support peg there at 1,840. Now, the US dollar has been quite on the benefit of a lot of the turmoil we've been seeing. It's also being in the benefit because interest rates in the United States is starting to pick up. People have actually been moving back into the dollar even before interest rates were raised because of expectation. And we still see that trend occurring right now. As you can see, although it's been a little choppy, right now it still has an upward angle. It slowed down a little bit, and that's why we're being a little watchful of support. But right now the trend on the US dollar is still to be able to strengthen, and I have not seen no major change to that particular condition as of yet. So you might be able to see some strength into the dollar continue nevertheless, but perhaps at a much more protracted pace, and maybe from this point, maybe a little bit more sideways. Now, crude oil. Now, the two main focuses that people probably are talking about in much of the news today really are China and oil. And of course, oil as an effect of course, what happened in China as well. But a drop in oil prices, as April pointed out, really affects quite a number of countries worldwide that are, of course, dependent in this particular type of commodity. And we can only imagine what the reverberations of such a low oil price will be. As far as you and I are concerned, we go to the pumps, put in gasoline in our car, and we have lower fuel. Wow, we feel so excited. We have more consumer disposable income to be able to use, but we don't see the impact of the greater side of what those things are, right? And so these things have to be accounted for. And I think Sholede attempted to be able to tell you about what the potential for OFW should be, particularly in the Saudi Arabian countries that are, of course, heavily employed there. And what happens if a lot of the businesses start to suffer, then it's but natural for people to retrench, retool, try to be able to bring business back to their own people rather than migrants. And this is an impending threat that can take place on, of course, our OFW crowd. And that could be quite a bit of a threat, especially if they're the ones sending the dollars back to the Philippines. But I think as oil has already fallen, it's already reached a level of major support that I'm getting to feel quite comfortable with in terms of drowning risk away. Last time we've seen oil prices back here was back in 2004, and we've seen major lows between a range of about $24 per barrel to about $18 per barrel. The low point we've seen in the last few days were about maybe $28, $27 per barrel, so that's not really very far off. Now, another consideration that you also have to look at is why is oil prices falling down? Yes, it could be partly because of China, also because of supply. And as, of course, many of you also know that there have been new productions of shale oil in the United States that contributed to oil supply. And, of course, there's been a rumored fight for people to try to drop oil to a certain level to force other people out of business. And it's really because of that OPEC has not really released too much on their production level. So oil production is remaining quite high. But if you can see from the graph that we have here in the upper end, the green line that you see is the total production, and it seems to be flattening off. It's not picking up anymore as compared to what crude oil's productivity is taking place. And so I think since it's flattening off, I think enough damage has been done, and I don't think that they want to be able to circumvent that. Now, if you're wondering, why don't they just cut production? Well, it's because they don't want to lose too much of the profits that they make. If oil continues to go lower, the only way to make generally the same amount of money is by selling more oil. And that's the reason why, of course, production levels are relatively still high, and they're really very fearful of cutting back too much. Especially when the people producing that, their cost of oil production is way much lower than maybe where market prices are. But there are countries right now who are producing oil below below that particular value, so they're losing money. Now, the effect of much of the crisis that, of course, April has presented and much what I showed you earlier really spelled itself out into major equity markets across the world. And if you can see the conditions we have inside this particular chart we have over here, you can see quite a number of them have already fallen quite deep. And looking at the highs that we've seen in 2015, many of that happening towards April of 2015, we've seen quite drastic drops, some of them going even way below 20% already. Of course, again, led by China, which is down about 42% in my last track of that about 2 or 3 days ago. Now, the only significance of this is, as April pointed out, there is a technical analysis definition that calls what is known as a bear market. And a bear market is defined as a market that falls down 20% off the top that it had shown, and it stays there along with different other indices. So that means there are other factors, not just one index doing it, and staying there more than 2 months in length. Now, if you were to look at that definition and break them down into pieces and say, does it all qualify? Does the definition actually call a bear market right now? Well, almost, but not quite. And the reason for that, to be very technical about it, is the only thing that's lacking is that it has not been here for more than 2 months. Okay? Now, the last time we had a major market correction in the Philippines, the Philippine index also fell below 20%. And after falling 20%, we had the same conversation, and people are saying bear market, bear market. Yes, I mean, it was a threat then, but the market just happened to rebound after that, did not stay there below 20% for 2 months, and it instead generated a very wide trading range as a correction impetus for it. Right? Now, will we have the same thing today?